Hello, everyone. It's a pleasure to moderate this panel. I'm Lukas Pfeiffer. I'm the founder of Crypto Oxygen and advisor to the board of DRH, monetizing sustainable energy with hybrid data centers. And I am delighted to actually have such distinguished panelists today with me, talking about how best strategies work for optimizing shareholder value in Bitcoin mining. So I would like to, Zach, to start introducing yourself and go around the table.
Zach Bradford, CEO of CleanSpark. We operate in North America. One of the largest Bitcoin miners. We currently have a little over 17 exahash of operating power.
Kulyk, CEO, founder of SunnySide Digital. We're a services and solutions provider to the data center space with a focus on digital mining, but also getting into the HPC ecosystem.
Gagnon, Chief Mining Officer at Bitfarms. We're one of the oldest and largest publicly traded Bitcoin mining companies, being founded in 2017. We're at 7 exahash right now, and we're going to 21 exahash by the end of the year.
Benjamin Yi, Executive Chairman of Riot.
Yeah, great. So we have heard today a lot about AI and HPC, so this is going to be not the place to talk about this. We are really focusing on the shareholder value. And in the past, we have seen that for a lot of investors, Bitcoin miners have been a proxy, a regulated proxy to go into Bitcoin itself. Now, with the ETF in January in the US and now today in Hong Kong, basically this distinguishing factor somehow has gone. So my first question is actually to Ben. What additional value do Bitcoin miners now bring to shareholders compared to that? To Ben, yeah.
Okay. I mean, in a word, outperformance to Bitcoin. Well, outperformance. When you look at what Bitcoin miners are and the kind of space that we fill in this market, we're here to drive outperformance to Bitcoin. If you want to track Bitcoin performance, that's what an ETF is for. It's a clean vehicle that's going to track the performance of Bitcoin up and down. But if you're looking to outperform Bitcoin, especially during a bull market, that's where the Bitcoin miners start to shine. You have relatively fixed operating costs as a business, and as Bitcoin mining prices increase, or Bitcoin prices increase, that means Bitcoin mining economics improve. You end up with rapidly expanding mining margins, which help you to outperform the price of Bitcoin itself. So, for us as a business and as an industry, I think the miners are here to drive outperformance. For our company, the way that we do that is we really take a kind of a data-driven approach to how we allocate capital, when we allocate capital. I think should be no surprise to any investor in here. The timing of your capital allocation is often your greatest determination of success, not really necessarily which company you buy in that industry sector. If the whole industry is going to go up, it's about timing the cycle properly. And so for us, we did an analysis of every miner that we've ever purchased since 2017, the price we paid, what they've generated in revenue when we plugged them in, what they've generated in operations. And really, we found that the best time to invest in mining is obviously when the fear and uncertainty is at the highest, which is leading into and leading out of a halving. So for us, we held off on growth aggressively when the economics were not as strong. And when we were leading into this halving, we really decided to go aggressively into our new miner expansion program. This means that this year we're going to grow 223%, so we're tripling our hash rate. We've got a 40% improvement in our energy efficiency. It's the most meaningful growth amongst the public companies this year. That's partly because we were really disciplined over the previous years. And that's how we plan to outperform Bitcoin this year.
You're talking about growth and hash rate, and that's actually a fantastic opportunity today, this panel, to look into different strategies in actually how to get this growth. So we have Benny here from Riot, and we have Zach from CleanSpark. We can see that while both are fantastic mining companies, they have quite a different approach in terms of holding BTC versus selling it to fund growth. I think CleanSpark has a higher hash rate today than Riot. Has seen incredible growth over the last couple of months, whereas Riot has a very big balance sheet when it comes to Bitcoin. Benny, what's the rationale in this? How do you do that?
I think, when we first started, this is our third epoch. So we've gone through 2 halvings. And what we're trying to do is build a sustainable business through the cycles, not just this cycle, but through all cycles. And what we're really focused on are 3 things. Number 1, a low cost of power. In Bitcoin mining, that is obviously a very important thing. Number 2, scale. And scale means sometimes you have to, it takes longer to build bigger things, and that's kind of what we're going through now. And number 3, in order to survive through the cycles, a very strong balance sheet. And so I think you've seen us play this strategy out, and in certain times of the different cycles, we are in favor, and in certain times we're out of favor. And I think there are lessons that you can learn from that, and certainly we're going to take some of these lessons learned. For example, you know, we haven't grown for like the last 14 months. Maybe we should have been doing a little bit more of that. But I think, you know, as you try to build a business through cycles, especially in this industry, which is incredibly volatile, you know, we're just focused on those 3 things. And we have a lot of growth on the come. We're going to triple our installed hash rate by the end of this year. And so a little known fact is by the end of this year, Riot will hopefully be mining more Bitcoin or even double the amount of Bitcoin that we were at the beginning of this year, even after the halving. So it really just is about building a business to last through many cycles.
Zach, how was your approach?
Yeah, we took a different approach, which was aggressively growing during when the fear was the highest. So many of our peers did stay on the sidelines, and what that did allow us to do is we grew at amongst the lowest cost of any miner that had built. And we're sitting here today with one of the most efficient fleets when measured by machine efficiency. And then we focused on having sites that were a little smaller, small still being, you know, 30 to 230 megawatts, but they were spread throughout an energy grid. And what that's allowed us to do is we really focus on our uptime, running 24/7. Our site power structure, it does not require power arbitrage, although we do have agreements with the grid to basically disappear and give the power back when needed. But we're built in a very abundant grid where we've actually never been called. We are compensated for it every single month in some of our power agreements, but we've never actually had to give the power back. So our strategy was in abundant locations where grid service are a little less needed, to spread the sites out and then to grow very, very heavily with a focus on high efficiency. We started the year at under 10 exahash at 17, so we doubled our hash rate already, I think, in February. We're set up to essentially double it again by probably July of this year, and we're actually targeting to more than triple it this year. So again, we feel that the key point is striking while the iron's hot when it comes, especially to the most expensive item all of us buy, and that's the machines, the fleet. And so I think we've done a good job of nailing the bottom. We've also been very choosy about which machines we buy versus not buy, designed specific to the type of infrastructure that we're looking for. Last thing really is that, you know, our background is in the energy space. That's how we got into this. We felt it was no better way to monetize power than Bitcoin mining. And so we've always started with that power first approach, which is where our high efficiency and high uptime have really always been our focus.
And let me dig into this point of high efficiency, high uptime, because that's actually another quite interesting factor that distinguishes also, I guess, Riot and CleanSpark. You guys are quite actively curtailing, and there seems to be a trade-off between maximizing hash rate, maximizing uptime versus maximizing also profitability. How do you go about that?
I think we could have done a better job explaining that those 2 things are actually independent of each other. If you are, you know, Riot, as we operate in Texas, it's hot. We had a problematic miner model, which caused us to operate probably around the 75% efficiency range. That would have been 75% with or without curtailment. Curtailment and our participation in the demand response programs that really dramatically lower our cost is completely separate, right? Now, obviously, when you're shut off, you aren't mining, but those periods of time are really, really short. So I think it's really important to realize that those two things are predominantly separate, but I think where we really shine is because of where we're located, because of our strategy to really optimize our power, even despite operating at a, let's just say, suboptimal utilization rate, we still came out mining Bitcoin for the calendar year 2023 at around $7,500 a Bitcoin, even despite all that, which is probably one of the lowest costs in the industry. On a megawatt hour basis, it's $22 a megawatt hour, which is, certainly in the lowest one or two cost producers in our industry, even despite the fact that we were running at that utilization.
And now, basically, if you look at a bit from the outside, Taras, you are an expert in also Bitcoin mining operations. What are the matrices that you're looking at when you're working with the firms?
Well, thanks, Lukas. Great question. We moved between our clients and ecosystem about 100,000 ASICs last year globally. What we've seen to date is certainly an increase in efficiency that's quite material. We've gone from 34.5 joule per terahash units in the S19 series down to 17.5 to 15 terahash, which has been 15 joules per terahash, which was just announced by Bitmain with S21 Pros coming out in Q3. So we're certainly seeing a massive increase in efficiency, but what we're expecting for everybody in the ecosystem is that material jump that we've been seeing over the past 2 years really slow down to incremental increase in efficiency. And what that means is that as these public operators really increase their efficiency of their fleet, we probably will see a tapering off of these massive fleet refreshes over the next 2 years. Probably will lead to consolidation in the space. I know certainly in the ecosystem that I work in primarily, which is in the wholesale distribution, we will certainly be seeing some M&A in the very near term. But we certainly anticipate it happening on the public market side, like we've seen with Hut 8, US BTC, Cathedra recently did an RTO with a major operator. So as the industry matures and the efficiency plateaus really over the next, call it 12 to 18 months, we will see consolidation and efficiency and scale really hit.
And help us a bit more to also dig deeper into really what is creating shareholder value for you as someone who is not directly within the public miner. I think when we spoke before, you mentioned the concept of all-in sustaining cash costs when you compare the different firms. What is that about?
Yeah, so before I was in the data center ecosystem, I covered traditional metals and mining and BMO Capital Markets. They've got a concept applied to public gold producers called the all-in sustaining cash cost. My idea and thesis is that as equity researchers get better to cover the space, guys like Anthony Power here in the audience, but traditional equity research folks, Goldman Sachs, JPM, et cetera, we will certainly see metrics that you can take CleanSpark, Bitfarms, a Riot, and have a single metric to be able to apply to see how they're comparing against each other from an operational efficiency basis. So I think that as the sector continues to evolve, we will see more sophistication on the equity research side that will help certainly manage the multiple disparity that we're seeing currently in the market today.
Yeah, that would be great. As it's still, as someone who is also analyzing it from the side, it's still not clear to fight your way through the balance sheets and the different P&L, but it's so that would be definitely helpful. And as said, from the all-in cash cost, energy is the single most important factor that distinguishes any operation. Ben, how does Bitfarms manage its energy? How do you go about it?
Yeah, so we have a different model. I mean, we have globally diversified energy portfolio, largely targeting areas with massive excess supply of hydroelectric capacity relative to local demand. So if you're targeting these large sources of large baseload renewable energy where there is a big gap between what is produced and what can actually be consumed locally, that means there's not a whole lot of drivers to increase our price. It also means that we have a high reliability on that uptime. So, we've got roughly 80% hydroelectricity throughout our portfolio. It's spread across 11 sites currently in 4 countries. It's quickly going up to 12 and 13 sites across those 4 countries this year, almost entirely hydropower. And that enables us to have a high reliability of our operations and also a very, very sustainable electricity price. And when we combine that with our energy efficiency, that means that we're an incredibly competitive producer of this product, this Bitcoin. And when you're looking at how these cycles play out, our thesis is we want to give upside to the investors, and we want to be able to capture as much of the upside as possible in a rapidly rising market. So if we've got to turn off our power, that certainly has advantages in a bear market or in a more of a conservative scenario. But in a bull market, the way that you get the most utilization out of your assets, the way you get the most return, the way you capture most of the upside is by having high uptime, is by having those predictable costs and those predictable operations. And that's exactly what we've delivered through our portfolio.
And how do you think shareholders now value BTC holdings versus growth?
I think that's an interesting question in the world of ETFs. It comes down to how investors actually want to allocate risk and manage their portfolios. Certainly when it comes to, if you just want the BTC exposure itself, you could buy an ETF, and if you want the mining exposure, you can buy a mining company, and you can manage that in your portfolio directly the same way that, and all 3 companies up here that are publicly traded are pure play Bitcoin mining companies. There's no HPC or AI integration in these companies because why would you want a company to do 2 things that are really not synergistic businesses when you as an investor can manage that in your portfolio individually? I think that the Bitcoin ETF also brings us to the forefront is a question of whether or not the investor should manage that in their portfolio or whether or not the mining company should do that. I think there's probably maybe a space for both. Certainly the companies with more Bitcoin in their possession trade at higher valuations. But really, I think it's going to come down to a lot of different individual strategies how companies want to maximize their value. We're growing our Bitcoin HODL, but we're doing it in a way where we're doing it out of cash flows and free cash flow out of operations, as opposed to raising debt or raising equity in order to fund the accumulation of that Bitcoin.
We saw the benefit of that. I mean, Ben, you touched on that multiple, right? Yeah. And we've seen companies who have kind of replicated what I guess ourselves and Marathon have done to essentially retain Bitcoin, prove out in an enhanced market multiple, which makes us more capital efficient from a cost of capital perspective, and that's been a huge advantage for us, both in bear markets and in bull markets, and I think that's going to continue to play out because we still continue to see that multiple persist. So, so it's going to be really interesting because I come from a commodity background myself, so it's definitely counterintuitive, right?
I think at least with our space in this particular commodity, there is no cost to hold it, right? It's not like it's barrels of oil that you incur an actual cost of storage in storing that energy, or gold where you have to pay, like a vault, you have to pay security guards and all these different things. The Bitcoin is digital. If you manage your system properly, there's really not a material cost to hold the commodity. So I think it does play in a different space, and they're not infinitely producible, right? So over time, the commodity should be appreciating in value faster than, say, like an oil, which the increase in value might actually be offset by the cost of holding onto that commodity.
We've approached it also with a strategy over ideology point of view. As an industry, there's a lot of ideology around Bitcoin and what it means. And so we took the counter-cyclical approach. And I think that our belief right now is the time to hold Bitcoin. We've held, over 95% of the Bitcoin we've mined since last June. Before then, we sold almost 100% of it, all the way up to that point. So we think that there's a good long runway ahead of us. We think it's going to be a little bit of a slow runway, but it's going to continue to build. And what we did last cycle is we looked for the signal of maybe where the rationality had left the building. And then you had events such as FTX and so forth. That's when we took the Bitcoin that we were holding and we sold it at the peak, and we took a strategy at that point for about 16, 17 months of use Bitcoin to get more Bitcoin. And I think there's going to be a time to do that inside the next cycle, because at that time when you measured, and we did this every day, we would go through and say, hey, what is our cheapest cost of capital? Bitcoin that we produce to sell it to get something, more machines, more land, more power, or is it to raise equity, or, the debt markets are essentially non-existent, but the little debt that was there to get access to that. And I think that that's how we will continue to approach it. And I think that that's truly strategic in what a business that doesn't have as heavy of an ideology would do. But right now, there's no argument that you get a better valuation for holding it. And I also think because there's so much upside in it in the future, that's the play for us now.
So we can see that across the panel, everyone likes to hold Bitcoin, and but you're not going to be religious about it, but rather smart. So that's it's going to be quite interesting to see if we're going to look at the market cap in the next couple of months, how this is going to play out, and to see different strategies. It's cool that we can follow all of this. So we've talked about the BTC holdings. We've also talked about energy as the biggest input factor, but as one of our topics is also operational excellence. And maybe, Taras, can you give us a bit of an additional trends? What kind of operational practices you see that sets different mining firms apart? What are they doing differently? What can be done to really get this efficiency?
Yeah, great question. It really is about managing hardware and your operations properly. Right now, we've got some great new type of infrastructure coming to market. Prior to about 12 months ago, 90% of the mining operations globally, the data centers themselves, were primarily air-cooled. What we've seen is a big transition or focus on immersion technologies. SunnySide's partnered with a great technology provider called Rosso Immersion, bleeding edge infrastructure on the immersion. We're seeing that actually play out across the market. There's major facilities in the UAE that are using immersion technology. There's immersion coming up all across the United States, Northern Europe, Scandinavia. One of the things that it really allows you to do is increase the power density of your facility and your units themselves through overclocking, but actually heat capture is also a major thing where you can not only mitigate the heat that's generated by your data center itself, but use that heat for other industrial applications like distributed water heating, food desiccation, et cetera. But most importantly, it actually increases your efficiency to the bottom line because you're able to actually concentrate your energy use in a smaller area, less operational overhead, less G&A for what you actually need to do, and really provide more returns for your shareholders. So that's one of the major things we're seeing. And then I touched on the hardware before where we're seeing major fleet refreshes. We're working with numerous partners to help them de-rack their old equipment, put in new equipment, clean, diagnose, fix, and then resell into the secondary market existing inventory so that they can apply that capital into what these gentlemen have been saying about their own fleet refresh programs. So that, again, also increases the total dollar return on what they've been putting in from a CapEx perspective.
We just hire you. Is that how you went? Yeah, okay.
No, Benny, you have, Riot, I think, has one of the first industrial scale immersion setups. What was your experience in this?
Okay, so the board, it had never been done at this scale before. We built 200 megawatts of immersion Bitcoin mining infrastructure, and at this scale, it had never been tested. But let's just put it this way: we've learned a lot of lessons in Rockdale. We are building and committed to building a 1 gigawatt facility in Corsicana, Texas, 100% immersion. Because, as I mentioned, we learned a lot of lessons, but especially when it comes to managing our power strategy and also dealing with the let's just say, heat issues in Texas, we have found that that's probably the way that we need to go.
How about CleanSpark and Bitfarms? How do you go about it?
Yeah, with immersion, we have built out a little over 20 megawatts now of immersion. We wanted to learn our lessons a little bit smaller, and we've really tiptoed into it. But I do believe that a very large portion of our fleet over the next 4 years, infrastructure that we build, will be immersion. Rather than trying to reinvent the wheel ourselves, though, our goal is to target and identify best-in-class partners for that infrastructure, at the actual tanks and the pumps and so forth. And I think it's a different approach. We, again, background in the energy space, we owned manufacturing. We used to do that. And our head of mining right now, he also used to work at a tank manufacturing company. And so having known all the difficulties that come with manufacturing, we are going to buy them from third parties. And the way we're testing those now is to always find what's going to work best, last the longest, and hopefully avoid, making a big mistake in making sure it has multiple years of runway ahead of it to be long and lasting.
And what kind of, for shareholders, what kind of additional efficiency percentage do you expect from that compared to air cooling?
I wouldn't say it's an addition. It just, when the machine is living in a nice warm bath for most of its life, it probably has a chance of lasting longer, right? And you can manage them just easier because they don't need to be they're not as operationally intensive because you don't need to clean them for dust, et cetera.
We have a different approach here at Bitfarms. We don't have any immersion. We're all air-cooled, and now we are dipping our toe in the water with some hydro miners. We've been building and operating facilities since 2017. We own our own electrical engineering subsidiary. We've built and designed, I think, over 9 generations of air-cooled Bitcoin mining facilities, and we know how to do it right. We know how to do it cost-effectively. And when we build out and grow our company, we're looking at 2 different things on the cost side. We're looking at what is the operating cost for running our equipment and maintaining our operations, but we're also looking at what's the marginal cost to grow our company on a per unit basis. And really the most cost-effective way to do that for us has been through air cooling. We have significantly simpler designs, we have significantly lower CapEx costs, and we generally operate in environments where there is not such an immense need for drastically advanced cooling technologies. So you can get, some improvements from the energy efficiency side, but on a CapEx side, we're getting significantly lower cost of growth, and we are a very capitally intensive industry already. We'd rather allocate our capital in a way that is as lean and as mean as possible in order to drive the best returns of investment for our shareholders. And I think that's something that we've been able to do through our air-cooled facilities and our designs.
It's fantastic. It's great. It's very exciting now. Fantastic time to see how these different strategies are playing out.